Hey guys, I just wanted to do a little analysis before the market opens back up later this evening. Today is November 27, 2022. And just been getting a lot of questions lately about technical analysis and where, how to approach it. A lot of confusion out there. So what I thought I'd do is just do a little analysis on trying to use as few, trying to just use some common sense here. Okay, a lot of Fibonacci, a lot of this, a lot of that. And it can be very daunting, it can be very confusing. But what I want to start with is, let's just start looking at the daily chart. Let's start with the daily chart. All right, this is bonds, /ZB. And, when you pull open a chart, any chart, and you are a day trader or whatever kind of trader, the first thing you want to do is just get an idea about what is the market doing that I'm looking at. Okay, so this is bonds, and very clearly, right, very clear. We're on the weekly chart here. Very clear that bonds is moving in what direction? It's moving up. It's moving up. Over the last several weeks, it's been moving up, right? Okay. So that's the first thing. It's really very easy, but it can be very confusing if you let it. All right, and hopefully this will kind of clear it up a little bit. Okay, so bonds have been moving up over the last few weeks. Now, that's the first thing I look at. What is the overall picture? And if you look out, the further out you go, the more clear the situation becomes. Right? I mean, you can see 1, 2, 3, 4, 5, 6, 7, 8, 10 months of declining price action. All right, now that's the big picture, right? That's the big picture. And it seems like this month, we've been ticking up. However, we have not broken past this previous month high, or we haven't broken past the previous month low. Okay, so that's key. I want to look for, one, what is the overall market doing? And two, what range am I in? Where is supply? Where is demand? Okay. So in the bond market has been moving down overall. That's the big picture. But lately seems to be trying to kind of press up a little bit. All right, so that's bonds. Let's look at this same picture, but on a weekly level. Okay, so every bar is going to be 1 week. And you can see, when you come down to the weekly chart, you can see we really started busting above resistance right in this last week right here on the 7th, the week of November 7th. What do I mean by that? All right, I'm going to take this level off. And what I'm going to do is first point out how these ranges, you see how they hold, like, okay, here's a range. And then in the following week, the market pressed back up into that range, but it didn't go past resistance level. Okay, it tested it, didn't go past it, and then it made a new low. All right, that's something that you really need to start kind of noting on charts. Like when these ranges are put in, they tend to stay. Like you can see, this range here was our last lower low. Right, all of these ranges were putting in lower lows, lower lows, lower lows. And then right here, this was the last lower low. You had a resistance level here. This is top, this is bottom of that range, and then boom, on 11.7 you broke above these two levels here. This where this resistance level was. You broke above this previous week range. Now that is a sign of market reversal. Some people call this an engulfing candle, meaning it just, the buyers at this point really stepped into the picture and started breaking above the previously defined resistance levels, right? So on the weekly level, we're moving up, right? We're moving up. Now there might be some monthly level up there. Let's go back to the monthly chart. There's a monthly level here that may come into play when you get in that around that area, but we're not there yet. We're not there yet. So we're gonna, as a day trader, your job is really to go with the current flow of the market, the current condition. So going into next week, we have a range here. They put in a high at 128.22. That's the previous week high. Here's the previous week low. And our assumption is going to be that the market's going to, it did actually pull back a little bit. It might pull back even more. And but our assumption is the market will pull back, but this level here, the support level, is going to remain intact, and the market will make a continuation, and within another week, we'll have a higher high. Make sense? Just like this. Look, okay, here's the beginning of a bullish formation. You had resistance. So this next week, this range remained intact. This one broke above. This one continued the trend, and it tested this range, meaning it pulled back into this range, but it didn't break down. It didn't go through and engulf the range. Okay. So now our assumption is that the market is a bullish market, and it will continue to be a bullish market. Now, even though we have a monthly resistance level here, that doesn't mean if the market comes up here, I'm not gonna short that. I'm not gonna just automatically put in a short order and just, hope and pray that the market goes back down. That's not how we do it here. Okay, we're continuation players, so we look at the previous month or the previous day, and we're playing off of that. So let's just put a little line here, and you can just to tell ourselves, hey, there's a couple levels here, but this is the previous week high. Okay, this is the level, high and the low. And we have some monthly levels that we're kind of paying attention to. All right, so let me take that off. Okay, monthly levels, weekly level, and we have a time level just telling us previous week was moving up. All right, so we're going to go to the 4-hour chart. And notice I'm not using any indicators, none at all. You don't really need them per se. You don't really. But they help. They can help keep you on the right side of the market. All right, so this is the previous day. This is Wednesday, Thursday, Friday. Now what I like to look at, and when I start zeroing in like that, is volume average. Okay, volume average, this indicator here. And what I found over time is that, volume average tells us where volume is happening in the market. Typically it's in the New York session. Okay. And when these bars are put in, they typically remain as support. Okay, here's a good example of that. See here. Okay, so they made a little high volume range here. And if you just highlight that, you can see how the market really bounced around in that range, and they made another high on high volume. Okay, so let's update that. Okay, high volume range here. Boom, and then it just pulled back into that and made another high volume range. So this is our next high volume range right here, right there, or here. Maybe grab that one too. So there's a lot of volume in this area. And the market 24th, you didn't have a lot of volume on the 24th because it was a holiday. And look at what it did. It pulled right back into the high volume area. And if you were to get in right here, that would have been a good move, because most likely this is going to continue. Okay, so they pull in and they make a continuation. They make a high, pull back into volume, and make a continuation. That's the V pattern that you look at. All right, so now let's just load in our entry chart. And now we have our typical drawings, but with a little bit more stuff added in. All right, let's go to the 1 hour. And you can see, okay, this is the area that we were highlighting, where we know that there was a lot of volume in this area. Market made a new high, put in a new high, weekly high, and then what it do? Pull back. This is what it does all the time. Pull back, usually back into a high volume area, and then make another extension. The indicators help with that, okay, because they can kind of tell you, hey, we've pulled back, but it doesn't tell you exactly where. It doesn't tell you exactly where it's pulling back into. All right. So that's kind of the bond picture. Weekly high, we're making weekly highs. We're pulling back into high volume, make another new high. Now, where the moving averages come into play is they help you kind of gauge where the overall periods are closing at. So here we're on the 1 hour, and this guy's looking at the previous 200 periods and saying, okay, from what I'm seeing, this is the average of where price is closing. The faster period moving average, the 100 period moving average, is above that, which indicates that in general, market is moving up. And typically what it does, again, it will get away from your moving averages and pull back into the average price. So this right here, right there, was a great entry point right in here. All right, okay, high volume. Now most people, let me say something about that. Now most people at this point, like if the market were coming at you and you saw a high volume sell like this, would you go long, or would you try to short the market? Okay, so most people would probably short the market because they think that is going to continue, or they think the market is crashing. But that is most likely an exhaustion level, meaning when you see one of these high volume bars like that, that's typically it for the day. That's the biggest move that can be made, and then it just kind of capitulates. So the wording is capitulate, like it's almost like an exhaustion level, like they can't push any further after that. And that happens on both sides. It happens on the sell side and it happens on the buy side. Okay, so an example on the buy side would be like right here. Okay, like see that huge push right there. Okay, now what did it do after that? Just the market, this is getting towards the end of the day. It didn't go much further than that because most of the volume happened right there in that first hour. That was the first move. Didn't just keep going up to infinity. Now the next day, when volume kicked back in and made another push up. But for that day, the volume was exhausted, or the movement was exhausted at that point. And that plays a big role in your trading. When to get in, when to get out. Okay, so looking over these last few days here. So let's say we know the market is moving up. Monday market, if you were to come in and look at this and it was Monday, okay, and you knew that the market was moving up based on your daily, based on your 1 hour. Now where would you get in? Which candles would you consider getting in on? You come in at noon, and would you say that's a pretty good location? Yeah, I would say that would probably be one of the best ones. You're located right in the range between the 200 and the 100. Your high volume. Don't look at high volume as a point to get fearful. Look at it as an opportunity, because most likely these bears are going to peter out, and that's the best entry to get into. All right, and the CCI here was 60. It was pretty good, but if you go down to your half hour, it would be lower than that. All right, so if you got in there, right, you get in there long, and where would you put your stop loss? Your stop loss is going to go below your estimated range. Okay, so, and this is where the moving averages come in great. So your 200 right here is telling you most likely price is not going to go below this level based on the previous 200 hours that I've been looking at. Okay, it's a lot of data right there. You want this to be a dragging indicator. You don't want it to be a leading indicator. You want it to it tells you a lot about what's happening with the market based on the past data. Right? So it's telling us that market's most likely not going to go below this level. And you can just look up here and see where your R1, R2s are. And you can kind of see, okay, the last higher high was somewhere around here. Right? So here's your range from here to here. That's your range. Okay, so market made a high, pulled back into, here somewhere. That's about mid-range. That's your entry point. Now what you're looking for is a strong push that's going to most likely be a capitulation point from the bull side. Right? There it is right there. Right? Because see, what happens is they make these big pushes and then they kind of die off after that. Right? So you're in here at a bear exhaustion point, and you're out here on a bullish exhaustion point. Does that make sense? This is the key to you making a lot of money in this thing, is to know, one, the overall trend. What is the overall market doing? Is it breaking out higher highs? That's what we started with, the big picture. Breaking out lower lows. That's where you have to go back to your daily chart and see what is it doing on a daily basis. And then you start looking at your 1 hour. Your 1 hour is going to tell you what the general range is we're dealing with, right? And then thirdly is waiting for an entry point. And that's where you pull open the volume and you try to find, okay, when you see these big volume bars, those are potential entry points. You still have to be able to look at the chart and say, okay, they pull back into the moving averages. Most likely they're going to be exhausted at this point and not be able to push through this entire range. And then you look further and you see, okay, you wait for this one or you wait for this one, right? If you there's an exit. See that exhaustion right there? Your stop loss is in here the whole time. Okay. You're not taking on a whole lot of risk. And some traders, they might have on a couple of positions and they're just adding. So this would be one. This would be number 2 in here. Then number 3 right here. Stop loss is here. Okay, 3 is here. Then when they get to another bullish move, okay, let's say tomorrow, on a 1 hour, you see this. You know when that's going to happen too. It's going to happen around 9, 11, 12. That's when the big volume comes in. You're going to see this on your volume chart. You're going to see a big high volume bar like this, where there's an average volume of 45,000, 30,000. Those are exit points. So you're getting in on exhaustion and you're getting out on exhaustion. You can add if you want to add, but I don't like adding. I think it's probably a ton of money in doing that, but it makes me anxious. But this is what we do. Let's look at oil. Because oil is good to look at because it's going the other way. It's going down. Okay, so the first thing, we'll take this up on another day. Well, we don't have to. Sorry, I thought somebody was here. They're not. Okay, so you can see just from the daily what oil is doing, right? Making lower lows on high volume. All right, so the range we're in currently is like from 76 to here. Okay, that's kind of our range right there. And what the market will do is it will come up, it will test this range multiple times, and then make a lower low. All right, so what we want to do, let's look at this on our 1 hour. What did it do? What does it do? All right, so put in the lower low, pull back into the ranges, close in those moving averages. This time, the 200 is above the 100, and that's telling you market's moving down. Okay, market is moving down. And let's just measure with a retracement tool. We can measure exactly how far in that range did it pull back. See, it put in the lows, pulled back 50% into the previous day range. Right? Your stochastic helps you gauge that exhaustion. Right? It gauges that exhaustion. And you know, at that point, see, at those exhaustion points didn't have a lot of volume Friday because it was a holiday, but you would have been looking for some high volume bullish spiking candles. The last time that happened was like here, a little bit higher average volume. See that? Right, a little bit higher average volume, pull back to the moving averages on higher volume. They were exhausted. And that's when the bulls came in. See that? So here, you're risking $2.40. And if you were out on exhaustion, you made $5 on that move, okay? From here, say you were in here. Okay, let's pull out the in volume. Not a lot of volume, but okay, you're putting your stop above the 200. So that's like $3. Okay, and then if you waited for exhaustion, noon, you made 3. So that was a 1-to-1. Right. And this is what it does. I'm telling you guys, this happens all the time. And if you know where you are in that cycle, you know, there's a cycle that's happening. If you know where you are in that cycle and you say, I don't want to take on that kind of risk. Well, now you can start zeroing in on your 1 hour and your 1 minute to find the more scalping type of trades, where you're really in and out. Okay, example. Okay, see, all in here. When the market was selling off, if you were a scalper, you're doing the same game, only now you're doing it on a faster basis. So you're in here, you're out here, you know, you're in here, you're out in here, waiting for those pullbacks, in on green, out on red. Right now, green, exhaustion, right? Okay, so this would be an entry. Stop loss above the 200. And you get out on exhaustion when you see a big spiking red bar like here. So like if you were in here, you would have been risking 90 cents, and out here 46 cents. Multiple opportunities there on that day. Requires a little more, this style requires a little more attention though to the chart. Like the other way, you are, you know, you're in here, you come back out, you can set an alarm. Usually these type of moves happen over 12 hours, you know, 9 hours, 6 hours. So you're in here and several hours go by and you're out here. Make sense? So you're not as committed to the chart when you're swinging. Okay, that's more swing trading. And the other way, when you're on that 1 minute, you know, and you're looking at your 1 hour for reference, you're on all of these little you're in and out on every little, you know, swing on this thing. It's just a matter of how much time you have that day. You can take a quick quick one. But it just it's for a certain personality type. All right, guys. If you like this one, hit the like button, subscribe, and there's a link that'll be provided here that will allow you to get in on our free seminars. We have events. I'll send you an update on that, and we have online meetings, which we're building, we're moving, we're shaking. All right, talk to you later.